Hello everyone and welcome back. This is the first lecture in the series of financial statement analysis. In the introductory session, I told you that this series will consist of 3 sections. So we'll start with the first section today. The first section is on understanding the financial statements. But before I give you an introduction on the basic structure of these reports and what they consist of, I must give you a little background into the accounting that goes into preparing these reports. Now, I will not get into debit, credit, or the golden rules of accounting. I will simply tell you how a business is started and what are the various terms that you use. How would the final postings of various transactions appear in the financial reports? So let's begin with this understanding. Let's first consider a person who is wanting to start a business. Let's call the proprietor Jason. Yes, I'm very fond of Jason Brown and that's why I'm taking this name. So Jason needs, say, $100,000 in cash in order to start his business. And let's say he has only $50,000 in cash with him. When he brings his own money into the business, it is called as capital. So this capital is, say, $50,000. And he gets to borrow the remaining $50,000 from a bank. So that we would call a loan or a bank loan. And he takes a loan of $50,000. So in what form does he get this money into his business? It comes in the form of cash, let's assume. So while we have a balance of capital of 50,000 and a loan of 50,000, we also have cash of 100,000. So this simple structure results in something which is called a balance sheet. If I just put a T form in it, I understand that T form is not in use anymore under any accounting standard, but I will still explain it to you because it is easier to understand when you are starting with the basics. So let me put it in a T form and I would call it balance sheet. So what does balance sheet comprise of? Balance sheet comprises of assets and liabilities and capital. So one side of the balance sheet or one portion of the balance sheet would consist of assets. Asset is something that a company owns. It has right on an asset. So now because this company has started, cash is something that the company owns. It has it in its possession. It has right on the cash. And that is why cash will be considered as an asset. But from where did this asset come from? It came out of a liability and out of the owner's contribution. So I will term capital as K because that is the usual nomenclature. What you must remember is that no matter what happens, the balance sheet will always be in balance. And that is why the name, that is why it is called the balance sheet. So assets will always be equal to liabilities plus capital. I will show you a few transactions. I will show you how the activities in a business happen, but that too will always keep the balance sheet in balance. So Jason has started a business and Jason has brought in cash, and this cash came from 50,000 of loan and 50,000 of his own savings. However, in order for a business to be sustainable, it has to do something. It has to generate revenue. And for that, it has to be employed in certain constructive activities. Let's assume that Jason is a tailor and Jason needs to buy certain sewing machines in order to start his work. Now, suppose Jason buys 2 sewing machines. So these 2 machines cost him, say, $25,000. Where did this $25,000 come from? This $25,000 has come from this cash that Jason has in his business. So we know that from here cash reduced by 25,000. But at the same time, 2 machines have come in the business. So the business now owns 2 more machines which cost $25,000. So that too has to come on the balance sheet. So as you can see, the balance sheet contains these machines, which has increased the amount of the balance sheet asset side by 25,000. But at the same time, because cash was used to buy these machines, cash balance has gone down by $25,000. And therefore, the balance sheet still remains in balance. Both these sides equal to $100,000 again. Now let's say in the business of tailoring, Jason has to make certain expenses which are electricity, rent, insurance, and let's give an amount to each of these. So let electricity be $200, rent be $2,000, and insurance be $50. At the same time, say Jason has employed a person to help him with the work, and he pays him a salary also, and let the salary be $1,000. Now because Jason is making all these expenditures, let's not let him go down the path of just spending. Let's make him earn something also. Now suppose with whatever work Jason has been doing, he has been able to earn $5,000. So $5,000 is an income for Jason. So we have listed certain expenses and certain incomes. So we can see that cash has been expended or cash has been spent in various things, including buying the machines, electricity bill payment, rental bill payment, insurance payment, and he has been able to collect some cash through his sales. And that is what we have called income in this case. So the question is, should all of these items go on the balance sheet just the way I have put the two machines? To answer this question, you have to ask yourself, does the company own any of these? Or does the company owe any of these? So, if it owns, it is an asset. If it owes to an outsider, it is a liability. Any item will come on the balance sheet only if it is either an asset or a liability. Or of course, the capital that has been contributed by Jason himself. This shows us that there is a difference between the nature of each of these items. While spending on the machines has given Jason something that he can use in the long term. His machines may last him 5 years, 6 years. So they will give him an economic benefit over a long term. And when I say long term, I usually mean more than 1 year. Any expenditure which results in our being able to utilize the benefits from that expenditure over a longer period of time would go on the balance sheet. However, the nature of these items is different. We know that electricity, rent, insurance, salary, all these have been paid, but they all pertain to a particular period. It may either be a month or it may be an year, but it is just one period. It will not give us any economic benefit over the long term. So, these are all considered as expenses, or you can also call it revenue expenditure. Same way, the income that we have earned, this is neither a liability nor an asset. Of course, the cash that comes in is an asset, but the nature of this, the income, is an income. It is our earning. So we will call it simply income. If I don't put my revenue expenses and my incomes on the balance sheet, then where do they go? Well, they go on a statement which is called the income statement. In India, it is also popularly known as the P&L or the profit and loss account, but in most of the other countries, it is called the income statement. So let's see what an income statement looks like. Once again, I will show you the income statement in a T form. That is just for ease of understanding. On the income statement, on one side, I will list the revenues, and on the other side, I will list the expenses. So let this side be that of revenues and this side be of expenses. And remember that capital expenditures will not go in the income statement. So what expenses do we have? We have electricity, which is of $200. We have rent, which is of $2,000. We have insurance, which is of $50. And we have a salary payment, which is of $1,000. At the same time, we also have an income, which we earned through this period, which is $5,000. So let's list $5,000 here. Unlike the balance sheet, the income statement does not balance out itself. we have to make an effort to balance it. And in the process of balancing the income statement, we arrive at something which is called the profit or the loss. So obviously, if the incomes are more and the expenses are less, what you earn is a profit. But if you have spent more than what you have earned, if expenses are more than your revenues, then of course you have suffered a loss. So let's see whether Jason has suffered a loss or he has earned a profit. As we can clearly see, the revenues total $5,000, and I'm not putting the expenses total here because here I need to put a small component which is called profit. So let's see, what is it? This is 3,250. So in my rough work, I will do minus 3,250, with which I arrive at a difference of 1,750. So this is my profit. So I'll plug in the profit figure of 1,750 here, and I will total the income statement such that the revenue side equals the expenses side, and we understand that the difference here is the profit. Now let's see what impact all these activities are making on the balance sheet. While we will not be using any of these names as electricity, rent, insurance, salary or income on the balance sheet, but we know that all these payments and receipts have actually happened in cash. So cash is one of the components on the balance sheet which is being impacted in all of these transactions. So while we made an adjustment in cash for the purchase of machinery, we must also make an adjustment for each one of these. So we know that we have earned an income of 5,000. So 5,000 has come in the business as cash. Sorry, we have not earned, Jason has earned. So Jason has earned 5,000 as income and 5,000 has come in the business as cash. So our cash increases by 5,000, but Jason has also made certain payments for all these expenses that we talked about, and as we had calculated the total comes to $3,250. So a payment of $3,250 has been made. So cash balance has increased by $1,750. Now let's see what will happen to this profit. Who benefits from the profit in a business? The person who benefits from the profit is the proprietor. So this money will be added to the capital balance of Jason. So while Jason's capital balance at the beginning of the period was $50,000, now he has also earned a profit of $1,750. So his capital balance goes up by $1,750. So essentially, if I total up these sides, I will see that my balance sheet is still in balance. Liabilities plus capital is equal to assets. So I hope this was clear. So this is how the various components of a business are represented in these two financial statements. So balance sheet and income statements are two very important financial statements of a company. They are prepared at the year end. However, they may also be prepared interim, either monthly or quarterly. Now let me show you how these statements look like for a company. I have got here a balance sheet of Axis Bank, and as you can see, the balance sheet is not in the format that I showed you. It is not in the T format. It is in a vertical format. However, the components of the balance sheet remain the same. So you can see that in the top portion, it is liabilities and capital, while in the lower part, it is all assets. So this is all assets. And as you can see, companies usually show their balance sheet and profit and loss account over different periods. So when these reports are published, they are usually given along with a recent history. So you can see that Axis Bank has given its balance sheet for 5 years, starting the year ended March 2011, year ended March 2012, year ended March 2013, year ended March 2014. And the most recent one of the year ended March 2015. Each of these balance sheets is for a 12 months period, as you can see, and this top portion is of the capital. This lower portion is of the liabilities. Same way, assets have also been segregated into liquid assets and fixed assets. Liquid assets and current assets would be those which you expect to utilize in a short period of time. However, fixed assets will be those which will be utilized over a long period of time. Some of them may even be depreciating. When I say depreciating, I mean that some of them may even be losing value over time. So in this balance sheet, we can see that this top portion is of current assets, whereas this portion is of fixed assets. The most important part to notice in the balance sheet is that the balance sheet is always in balance. That is, the total of the liability side will always be equal to the total of the asset side. And this will happen for each of the years that you see. Now let's move on to have a quick look at the income statement or the profit and loss account. Here on this slide, I have the income statement of Axis Bank. And again, as you see, just as in the case of the balance sheet, the income statement presented is also for 5 years in succession. While it is not in the format that I explained to you, this one is in a vertical format, but essentially it is still the same. So this top portion is of incomes and this lower portion is of expenses. And the difference between the totals of incomes and the total of expenses is either the profit or the loss. And we have, in this case again, the incomes are more than the expenses, which has resulted in a profit. Well, I hope that is not too much information for one lecture. I would expect you to go through some statements on any website that you like and review them. And in the next session, I will take you through the cash flow statements. Thank you very much.